Hello, good evening everyone, and welcome to this session on technical analysis, and also we'll be talking a bit about fundamental analysis. This is a free webinar session that's done every 2 weeks, done fortnightly by dkbMARKETS, and we talk about different topics on trading, mostly about the basics of trading. And today we'll be discussing technical and fundamental analysis, which are crucial parts of trading, as we all know. Now, what is technical analysis? I'll just go through some definitions, some textbook definitions of technical analysis. One of the common definitions for technical analysis is a method of studying the market activity, and the market could be the forex market, the commodities market, the stock market, or indices. So it's just a method of studying the market activity and the patterns on a chart to discover trading opportunities. So that's one common definition for technical analysis, just a method of studying the market activity and patterns on a chart to discover trading opportunities. Another popular definition for technical analysis is the graphic representation of price and volume movement over time. And the last common definition is the forecasting of market prices by means of analysis of data generated by the process of trading. So these are three very common definitions for technical analysis. Basically, it's just a way of looking at the charts of the market you're trading and looking for opportunities to get in and out of the market just by analyzing the chart. So that's what technical analysis is all about. Now, technical analysis is not just useful to the short-term or intermediate-term trader, but it's also very useful to the long-term investor as well. It's absolutely crucial when you're trading. Not so crucial with long-term investing, but it certainly would help you know when to sell your stock or change your positions in your long-term investment portfolio once you have the knowledge of how to read the charts of what you're investing in. So it's not only useful to the short-term investor or the short-term trader, but also very useful to the long-term investor as well. So to be a successful trader, which is what we focus on, to be a successful trader, it is vital to learn how to study charts, because inability to read, understand, and interpret the charts of the markets you're trading leaves you severely handicapped. And obviously this involves you reading books and articles on technical analysis. Continual education is very important in becoming a successful trader. So if you're new to trading, it's very important you get the books out, you go online, you go for seminars, and you need to study, read books, learn about technical analysis and how to read charts, because it's a very vital component of your success as a trader. Now, always remember that technical analysis will not predict the future. It's very important you always remember this. So no matter how well you analyze the charts you're looking at and how you analyze the market, technical analysis will not predict the future. But it will help you assess the market and make logical decisions. And that's all you can do as a trader. So long as you constantly make logical and sensible decisions in the market with the aid of technical analysis, then it will improve your success as a trader, but it would not predict the future. It will just help you assess the market and make logical and objective decisions. Now, one of the most important aims of chart analysis is to determine the trend of the market. And I always advise people I teach how to trade that that's the first thing you want to do when you're looking at the charts. So the first thing you want to do when you look at the charts is to determine the trend of the market. Now, a very old and popular saying in trading is the trend is your friend. Now, the trend is the observable direction of the market, which could be up, down, or sideways. Now, trading in the direction of the trend significantly increases your odds of success. So you always want to trade in the direction of the trend. The trend, always remember, is your friend. Now, indicators are another vital part of technical analysis. And the definition for indicator is any mathematical calculation that is represented graphically upon a chart is called an indicator. And the best way I always advise my students to remember this is that anything you see on the chart other than price and time is an indicator. So anything you see other than price and time is an indicator. And that's a very quick and easy way to remember what indicators are. But that's the textbook definition for indicator is any mathematical calculation that is represented graphically upon a chart is called an indicator. But like I say, from a practical point of view, anything that is represented on the chart other than price and time is an indicator. Now, indicators help in the analysis of the markets. It is important not to use too many indicators on your chart because this can lead to confusion and hamper your trading. So it's very important you use 3, maximum 4 indicators on the chart. So although they're very helpful in helping you to analyze the market and make objective decisions, it's very, very important not to use too many indicators because it can confuse you, it can hamper your trading because they can conflict each other. So it's always advisable to use 3, maximum 4 indicators on the chart. I usually tend to use just 2 indicators to make my decision when it comes to trading. So don't become too technical with this or what we call analysis paralysis, where you're trying to use too many indicators, you just paralyze yourself. Now, indicators are used to determine entry and exit points in the market. So they're very, very good in helping you determine where to enter the market and most importantly also where to exit the market. So these are where they become very, very helpful in terms of aiding your trading. Now, there are different types of indicators which you can use. I always advise traders again that there are so many indicators out there. The aim is not to try and learn all of them or try and master all of them. It's just best to use the ones that are commonly used. Be aware of the ones that are commonly used, study the ones that are commonly used, and then obviously decide which ones you want to apply to your trading depending on your trading style, the market you're trading, and your capital. So these are the few commonly used ones. Such as candlesticks. Candlesticks are a very, very popular indicator and it's very important to learn about candlesticks. Trend lines are also very popular. Channels are very popular. Support and resistance is a very important part of trading, trying to determine the support and resistance of the market. Moving averages, very, very popular and very important you know that. Pivot points indicator, very good. A volume indicator, Fibonacci retracements, oscillators are very popular. Williams percentage R is another popular indicator that can be used, and the Mark D is also a very, very popular indicator in technical analysis. So these are the commonly used indicators, and my advice is that you try and read up on these different indicators. Learn about them and know how to apply them. Some of them we'll be discussing in detail in subsequent webinars, but these are the ones that are commonly used and I will advise you to know them well. Now, indicators are also categorized into different categories. You have what we call leading indicators. So the leading indicators are designed to lead price movements. So examples of leading indicators are the Commodity Channel Index, or the CCI, the Relative Strength Index, the RSI, and the Williams Percentage R. These are examples of what we call leading indicators, which are designed to lead the price movements. And then the other category we have are the lagging indicators. And these lagging indicators, they follow the price action, and they tend to be trend following indicators. So examples of the lagging indicators are the moving averages and the MACD. These are examples of lagging indicators. So in a nutshell, that's just a summary of what technical analysis is all about. But obviously, once you know that about technical analysis, it's also important you're aware about what we call fundamental analysis. Now, fundamental analysis is just the examination of the underlying forces that affect the well-being of the economy, and also the industry groups and companies. So I'll just repeat that again. The definition of fundamental analysis is the examination of the underlying forces that affect the well-being of the economy as a whole, the industry groups, and also the individual companies. So the goal of fundamental analysis is to derive a forecast and profit from future price movements. So as stated in the definition, fundamental analysis is done on 3 levels. So when you're doing fundamental analysis, you start from the economic level and obviously assess the forces that affect the well-being of the economy as a whole, the national economy. Then you go to the industry group level, and then finally the company level. So you have to do your fundamental analysis on 3 levels. So the national economy level, industry groups, and then the economy. That's proper fundamental analysis. So what are the advantages of fundamental analysis? Fundamental analysis is very good for long-term investments based on long-term trends. So if you're a long-term investor, fundamental analysis helps you make good decisions regarding your long-term investment. They're not so good for short-term trading or especially day trading. They're good for spotting valuable stocks, in terms of doing your proper fundamental analysis, so you can spot valuable stocks. And obviously, by the time you go through a thorough analysis of the national economy, the industry group you're looking at, and the individual company, you will develop a thorough understanding of the business you're assessing. Well, anything that has advantages also has disadvantages, and the disadvantages of fundamental analysis is that it's time-consuming. It's time-consuming to analyze and go through all the data and assess the data and make a judgment. So going through, national economic indicators like consumer price index, gross domestic product, interest rates, unemployment, then coming to the industry group, finding out the supply and demand in that industry group, the qualities of that industry group, the players in that industry group, and then going to the individual company, going through the financials of the company, knowing who's on the management board, knowing who the competitors of that company are. This can really be time consuming when you're doing proper fundamental analysis. And obviously, after you've gone through all that analysis, your conclusion tends to be subjective. So it's all subjective, what you think is the result of all your analysis. So a fair value of a stock you're assessing is just based on assumptions you're making from the data you have assessed. And finally, you have what we call analyst bias, because the majority of the information that goes into the analysis comes from the company itself, and it might actually be false information or wrong information in your analysis. So these are the huge disadvantages of fundamental analysis. And like I said, when it comes to trading itself, you haven't really got time to do proper fundamental analysis. So as a trader, technical analysis tends to be much more important than fundamental analysis. Okay, so that's just a summary on technical analysis and fundamental analysis. So like I said, it's very important you do study a lot, read up about technical analysis and indicators because they will be very important in your success as a trader. Okay, so if you have any questions, do click the hand button or send your questions through the question box.